Hi, all of us are well aware that inflation has relevance to us as consumers, but there are times, especially now, when it has great relevance to us as investors. As you know, in last week's monetary policy, RBI held on to the low interest rates and said that inflation, which in this case means the consumer price index, the CPI, will remain low, relatively speaking, meaning go down from current levels. So this should be good news, right? Except that there is another measure of inflation, which is the wholesale price index, the WPI, and there the inflation is at a 2-decade high at 13.5%, whereas the consumer price inflation remains around 5 and odd percent, and RBI is projecting it to go down. So why is this not so good news for you as investors? The wholesale price index to an extent measures the price inflation for the producers. So this has been a time when a lot of commodities have gone up. There have been international supply constraints, all of which have pushed up prices for the producers. The costs have gone up, but they have not been able to pass it on to the consumers, because normally what happens is when the WPI goes up, the CPI follows with a lag. But this time that differential has remained for very, very long. WPI is 13.5% and the CPI is at 5.5 or 5.6%. So that gap means that there is a lot of margin pressure. It's already been visible in Q3, where non-financial companies have seen a margin compression by 2% points, and this has been pretty much across industries, from autos to chemicals to FMCG to capital goods, and this trend is only likely to accelerate in Q4. So when investing, you will have to keep this in mind, that on one hand, producers are facing cost pressures. On the other hand, because the demand is not so buoyant, they are not able to pass it on to consumers, and you're seeing it in margin compression.